Okay, well, why don't we get started? And if you don't mind coming on video, it's preferable just because it helps me when I'm presenting, just seeing if you're bored, I'll move on. Or if people seem confused, but it helps me to see people's expressions, as I'm doing this. So if you don't mind coming on video, that'd be great. And happy Financial Fitness Friday. We haven't done this in a while. It's kind of been crazy for a bit, but I'm trying to get onto a regular monthly, at least, routine, and kind of basing it on what's going, what part of the year it is. And I thought this would be a good way to start off 2026 with, since it's about it's tax season, looking at the One Big Beautiful Bill Act and how that impacts you. Here's a disclaimer. This is meant for education. This is not specific tax recommendations or anything, specific advice. But hopefully you find this valuable. And if you don't mind, if I can get people give me a thumbs up that because I'm recording this, but I'll post it on to YouTube for people to view. So can you give me a thumbs up that you all agree to allow the posting? And obviously I'm not getting paid for this, so you don't get paid for it either. Okay, good. Okay, I think we got about everybody. Okay, hey JB, good to see you. Hey, I just put the disclaimer. This isn't advice, or this is educational, and I do post these on YouTube for people so they can view for free. If you can give me a thumbs up that you're good with that, appreciate it. And let's see, then we'll go from there. Okay, so the One Big Beautiful Bill Act, it was actually passed in July 4th last year. And this kind of summary, this is what, it's major tax changes for this administration, really. And these are the things we'll kind of cover on here. And specifically for 2025, what can you take advantage of? And what are the implications for the upcoming years? Some people won't be impacted much, but some people will, and maybe you may want to adjust even their W-4 withholding, so how much they're getting taxed out of their paycheck. But for the vast majority, you probably want to make any changes. So first, the big thing is tax brackets were permanently extended. By permanent, I mean with a pencil. That until the next administration comes in and changes them again. This was the Tax Cuts and Jobs Act back in 2017 that said, took these from 10, 15, 20, 25. It lowered all the tax brackets, and then this made these permanent, as you could say, in pencil. Also the big thing, 10 and 12%. Those brackets are now going to be adjusted for inflation. So you'll see these numbers change according to the inflation for the year. So we'll just see those larger brackets, basically. So from this, I mean, who's the biggest winner from the One Big Beautiful Bill Act? In my opinion, it's just the richest people again, because we didn't change tax brackets, which is kind of stupid when, in a sense. It was 39.6%. And so we're still, historically, we're in a very low tax bracket. And so I anticipate down the road, we're going to have to raise taxes. We can't, if you keep going deficit spending, we just can't always do that. But this is the highest tax brackets. And we've been hovering really relatively low, considering. And the biggest losers, yeah, go ahead.
You're not sharing if you.
Oh, geez, I'm not.
Yeah.
Okay. Oh, I didn't say thank you. I didn't realize that. So go back. There we go. I thought it was already sharing. Sorry about that. Yeah. So here was, I guess, the disclaimer. This is not advice, but this is the one big, this is what we're covering, what it, you know, what it all talks about, the tax brackets, increased standard deduction, all these changes, which impact some people, especially people with kids. But these are the tax brackets that I was pointing out. These have stayed permanent with a pencil, and 10 and 12%. These two brackets these are gonna move with inflation, from 2026 onward. So, and then what I was saying, the biggest winner really is the richest people, that since they're not getting their those taxes, they're we're historically, this is what our tax brackets have been. This is the highest tax bracket, and then this is the capital gains tax rate. So, but not going back to 39.6, that's the biggest, they make up the most. The biggest losers, sadly, is our planet, our energy. When we got rid of all the energy credits, which I don't understand, that was the biggest reason why people were getting solar, was it was a good thing to get these credits where you could, it's 30% credits. There was no phase out. It just ended December 31st. And that, so sadly, the anticipation of people installing solar is dropping by like 46% is their estimation. So this is what they were projecting, how many homes would get it. And the a relative, energy savings, how much less, CO2 we'd emit, but that's the way it goes. But I don't see many people likely getting solar. We'll see as the year goes on. But we actually switched how we were doing our remodels and got a roof replaced and did solar this last year. But that was in September. We're like scrambling to try to get it done. But we'll see. I'm curious to see what's going to happen to solar companies as well as. It's just there's I think 7.5% of homes actually have solar, and it's probably not going to, sadly, not going to change very much. And then this is an interesting, so here's what our deficit has done in relation to our tax brackets, so those highest tax brackets. Is it a causation? Not really, can't say that, but there is definitely a correlation there, that our national debt has increased significantly as we've dropped the tax bracket so low and just made more deficit spending. Here's the standard deduction. This is one of the good things that's going to impact all of us. It went up for 2025, up at $750, and there's going to be additional increases. This year it's already single is 16,100, and married, filing joint is double that. That once again, since the Tax Cuts and Jobs Act, prior to that, approximately 33% of people itemized their taxes, meaning their deduction was greater than the standard deduction. Now it's only 10%, and with these increases, it's going to happen. So what do you do there? If you're not in a high tax state, you're probably just doing most people will just be doing the standard deduction. But if you're charitably minded, if you have significant property taxes, there's ways to arbitrage this to where one year you might do all your charitable donations, you might pay all your multiple property tax bills at the same year, and then you have this huge itemized deduction, and then the next year you can do a standard deduction. So that's ways you can take advantage of, since these standard deductions go up so high. Some people might contribute to charity, but it doesn't give any tax deduction because they don't go above the standard deduction. So that's something you just gotta be smarter about in planning to take advantage of this. Any questions on that? Okay. And as I already said, most people will just take the standard deduction. About 90% or more will likely just take the standard deduction from now on. Okay, SALT. This is significant for especially people in California and New York, high tax states. This was significant. So when the Tax Cuts and Jobs Act went into play, and they lowered the tax brackets, it actually kind of screwed people in high income tax states like California and New York, the blue states, really. Be because what they did is they cut this SALT is state and local taxes. That's your property taxes and all the income taxes you're paying in the state and local. They capped that at 10K, which they is so suddenly before you could deduct that off what you're paying on the federal taxes, how much you were paying. Now for a few years, they've, it's until 2029, it's jumping up to $40,000 by 10K. Married filing's separate. Most people should never file that way if they're married, unless typically the only time is if somebody's on a student loan payback plan. That's kind of really the only smart time to do married filing separate. But notice the big thing though is if you're a high income earner, these SALT taxes phase out. So if you're you can, if you're between 500, if you're over 500K household income, you can, that SALT deduction will go back down to 10% as it phases out. So this really impacts only people that itemize. And so that was, well, I said only 10% will itemize. More, there might, in California, in New York's, real high income tax states, that number might go up because thanks to the SALT increase in SALT taxes for the next few years. Any questions on that? Is it quiet? Okay. And then once again, that reverts back to 10K in 2030 unless it's extended. Okay, this is one that probably most people this doesn't impact, but the no tax on tips and the actual limits. So, and what's kind of funny, I remember, heck, one of my first jobs before I was in the Navy, I actually was a bellman. After waiting tables, was like a bellman / driver and a valet. Talk about an easy job making tips. But the people in Las Vegas, those valets, I remember this was, years ago, but they would sell their job to when they were retiring. That's how much money they made in tips. And so while this is a below the line deduction, which the line is basically your adjusted gross income. There's certain things that are above the line. So you've got your gross income. And then if you do 401k contributions that are pre-tax or health savings account, those kind of pre-tax things, that lowers your total income down to adjusted gross income. And then there's other things below AGI, that's all considered below the line deductions. And a lot of these are below the line deductions. So it doesn't impact your AGI, which is your AGI determines whether you can contribute directly to a Roth IRA. All those contribution limit kind of things is based on AGI. These are all below the line, so they don't impact your AGI, but they do give you tax credit, what your actual taxable income is going to be. Does that make sense? Okay. So as far as the taxes go, there's a maximum of 25K. But there's all of these have phase outs, and it's really kind of small. And I know people that complained about it, like especially in Vegas, where they make these, significant money in tips. And everything has phase outs. And really, though, this does help who I think it's supposed to help, like the person cutting your hair, the waiter, it's helping the people that don't have a huge income, not taxing their tips. So to me, it's hitting the right people. That's just my opinion. Any questions on this? But I think that's one of the big notices on tips is that people, there are limits and there's phase outs. No tax on overtime. This is one that's confused on people too. Most people are on a salary. You don't get overtime if you're, non-exempt. So, but this is for people that work on an hourly basis or something like that. If you work overtime, it's not all of that pay that is tax-free. It's if you make typically overtime pay is 150%, right? Time and a half. It's just that additional half that you don't get taxed on. And it's, if you look at it, it's not that much. Like the max deduction is $12,500. So that's not significant. It is something, but it's not a huge amount. And once again, look at it. Look, AGI caps. Single, it starts phasing out at a AGI income of 150K, and then 300K for married finding joy. So just like I was explaining, example, if a worker earns $20 per hour normally, they get $30 time and a half for overtime. It's just the $10 that's eligible for this deduction. Make sense? Okay. Okay. And as mentioned, all these taxes are still subject to payroll tax, AGI, and potentially state tax. So it's just the federal deduction that's below the line. Okay, new deductions. This who does really well too. So this is kind of, we're trying to not tax Social Security, which is kind of annoying that we're taxed partly on Social Security when we've been taxed on it all throughout our life to get Social Security. But Trump was trying to get rid of, taxes on Social Security. A number of states don't. But depending on how much income you have, you can get zero of your Social Security taxed, 50%, or 85% of it is taxed based on how much your income is. But what this does is kind of account for that. I mean, it's giving additional, for people that are 65 and older, they're getting an additional 6K. So it's kind of like giving, trying to account for the taxes people are getting paid on Social Security. So two people, if they're both 65 and older, you can get up to 12K per couple. But if it's, significant age difference and one's 65 and the other's 50, there's only 6K that you can get. Another cool thing that is temporary is car loan interest deduction. Once again, look at the small cap on the bottom. For single head of household, 100 to 150K, it phases out. And then 200 to 250K in high tax states like California, that's just not very much. But on this new car, this is not permission to go buy a new car because you get a tax deduction, okay? But if you need a new car, this is something, and you're below that, the phase out. Maggie is just modified adjusted gross income. It just accounts for tax-free interest, as well, that you have to add back in. But final assembly has to be in the US. So what you can look at is that's something you want to make sure of it when you're buying the car, because if it's in Canada, no, you're not going to get the tax deduction. So, but if the VIN number starts with a 145, you should be able to get this deduction up to $10,000 a year on that interest, so long as you meet the you're not within the phase out range. Questions there? Okay. Once again, that goes till 2028, and we'll see what happens then. And it's personal use cars. So if people are buying a work, as a work car, doesn't count. It's just new and personal. Yes, Gina.
Does this apply for electric cars?
No. So the electric car credit went away in September 30th of 2025. If it's, yes, but it will count for electric cars that are final assembly in the US, absolutely. Okay. But that's different than what we had up until September 30th, where there was you got a tax incentive by buying an electric car. Yep. Yeah. Okay. But that went away. But it kind of replaced it, I guess you could say. But it's for any car, whether it's a gas guzzler or electric or hybrid. Okay. Okay. Charitable deductions. So this was kind of a pullover from COVID. When COVID hit, even if you don't itemize your taxes, you're just using a standard deduction, you can contribute up to $1,000 towards charity and take that, and $2,000 if you're married. as a tax deduction, which is below the line. So if you, it's something, so if you're contributing, even like, giving stuff the goodwill all the time, keeping receipts and writing that down, that's up to $1,000 you can take off even if you don't itemize. If you itemize and you do a lot of charitable donations, then that's where you likely you itemize and you can get much more, obviously as charitable donation. But they changed it to where now before you get any deduction, you have to, there's a 0.5% AGI floor on charitable donations before you start getting any deduction. I'll go into that next. But for these non-itemizers, the charitable deduction, it's got to be in cash, so it's not equities. And you can look up 509. I'm not going to go all in detail, but most charities, you just can't do certain supporting organizations. So any 501c3, et cetera, still works, which is probably where you most would be able to do. And it's not allowed for creating a donor advised fund, which is a donor advised fund is what I promote for people that are into charitable donations. And that's how you do tax arbitrage, where you might use itemized donations 1 year and then standard deduction for a few years. And you just load up your charitable donations in 1 year, and then you control that money. It's not yours. You've given it to charity, and you take that whole lump sum deduction that year. But then you can, divvy out that money over many years to different charities. Okay, this is another really good one for people with children. The enhanced child tax credit. So this is for people that have kids and several kids. This is where you might want to go in and adjust your W-4, because you're getting a decent, $2,200 per child under 17, and then that's going to be indexed to inflation starting this year. Once again, just like anything I said, there's phase outs. So 200 to 244K, it phases out from 2,200 to 0. Same thing for married filing joint, 400 to 444K, and that is not indexed to inflation, which means as our salaries go up, it doesn't. This doesn't change. The same thing happened with the NIT, the net income, the taxes when Obama added that 3.8% on capital gains. That salary is not indexed to inflation. So, 20, 30 years when people are making way more money, it doesn't matter. You're getting this higher taxes based on some 2008 something salary, what they stated. Refundable, this means you can actually, even if you don't pay taxes, you can get up to $1,700 back for this child tax credit. A lot of tax credits aren't refundable, meaning if you're not, it goes, you don't get money back. If it just drops whatever you would owe down to a certain amount. But with this tax credit, you can actually get a check from them, for up to $1,700, and that goes up with inflation starting this year. Any questions on the checks? Yep.
Just a note, be mindful of the 17. It's the year they turn 17. Yeah. I may have gotten hit because my daughter turned 17 in November and didn't think about it until I did my taxes. So just be wary of that, because it drops from 22 to like 500 as a dependent. So
yeah. Good call. Yep. Okay. This we were talking a bit earlier. So now for itemizers and charitable donations, they've added this. Nothing like trying to make donations to charity even harder. That's how I see it. So 0.5%, you've got to contribute at least 0.5%. None of that's tax deductible, and then anything else above that will be deductible. There's limits on how much you can give in a single year to charitable charities. In general, if it's cash, it's 60% of your AGI. But if it's the one I really want to focus on here is the 30% appreciated capital gains. That's to me, that's the smartest way to do charitable donations is you donate appreciated stock. Because if you do that, that's where you use a donor advised fund. If you, let's say you have some NVIDIA stock that's went up, 20,000 times or something, that's a huge capital gain if you sell that. But if you're charitably minded, all of this is obviously if you're just charitably minded, but if you donate that stock to a donor advised fund, you don't pay any capital gains taxes. All of that value of what you put in that donor advised fund, you get a tax deduction for. You don't pay taxes. The charity doesn't pay any taxes. The only loser is Uncle Sam because they don't get the capital gains taxes. So in terms of smart charitable donations, that's the way to do it. But it's limited to 30% of your AGI. Doesn't mean that, and if you go above 30%, that's carried forward to the next year, but it's just important to know in general. Here, go through a couple examples of, let's say you have 100K, your adjusted gross income, and you give 50% appreciated stock to a public charity. We'll just go through what's deductible. That 0.5% AGI, so right off the top, $500, doesn't count. So 50K minus $500, that's 49.5K that's deductible, a deductible contribution before that 30% limit. Since it's 30% is the max you could contribute that's tax deductible is 30K, you just donated 49.5K that's deductible. So subtract that year, 30%, you'll drop your taxes, 30K, and then 19.5K will be carried forward to the next year that you can use. And then, a smaller example where you don't go above the 30%, which is, I'd say most people don't. If you gave 20K with the 100K salary, you get $500 still subtracted, the 0.5% AGI. So 19.5K is deducted and nothing's carried forward. Questions there? Okay, other itemized deductions. So the Tax Cuts and Jobs Act also made, and this once again hits states like California, Hawaii, New York, where it's really significant mortgages. But you're limited to 750K of total indebtedness on all mortgages. That's going to be that's tax that interest is deductible. So if say people have a bunch of rentals, it doesn't matter that it's a limit on all mortgages, the maximum of 750K that can be used towards what can be deducted from taxes. What's interesting though is they have added PMI for the mortgage insurance that can be deducted as well. Which is pretty cool because especially for first-time home buyers, unless you have like a VA loan or something, if you don't put down at least 20%, you get stuck with mortgage insurance, but at least that now is deductible for a while. And then these are just some other things. Hopefully this last line doesn't include any of you. Gambling is not investing. But they did update how much your losses you could deduct starting this year. Okay, this doesn't impact most either, but they kind of limited. It sounds weird, this 237 rule, but people that are in the highest tax bracket, the 37%, your deductions are worth less than that. They basically cut 2% off, so it's like you're getting deducted you're in the 35% tax bracket in terms of deductions. So for every $1,000 of deductions, you're really only getting to deduct $950, but insignificant. Okay, this is kind of cool though. They keep expanding the 529 expenses. So years ago they added up to 10K for K through 12 expenses and private school. but in addition to tuition, now you can do public, private, or homeschool expenses, and all of these things, you can use this 529 for. It's a limit of all the accounts, everything to 20K, but that's pretty significant. And that applied obviously after July 4th of last year. And here's some more for post-secondary credential expenses, which is kind of cool. So it doesn't have to be a specific degree program, but specific industry recognized or accredited by major credentialing organization. Those also can be, 529s can be used for that as well. Which I kind of anticipated these things to happen. People stuff as college costs have went up so much, but you're like, how much do I put into a 529? Because you don't want to put too much in, but what makes sense, and what if my kid doesn't go to college? I figured they'd start opening it up to other avenues as well of how to use that money. And this is one example of where they're doing it for credentialing programs, like even earning, certified financial planner. For that, I was fortunate to get a scholarship for that, but otherwise that would probably cost $7,000. People have even more, depending on the school they go to. So, but that's kind of the benefit of that. Okay, now the Trump accounts. This is significant. I don't see Alec on here, but for people that have children born January 1st, 2025 until December 31st, 2028, the government's giving $1,000 free in this, basically a baby Roth IRA account. You can also contribute up to $5,000 per year. Then that's going to be indexed to inflation. And this doesn't have to be earned income. But the no distributions are allowed before the beneficiary turns 18, and depending on the state, they're still trying to figure some of this out. All the details aren't exactly certain, but at least at 18 right now. But the age of majority is different in different states. So that could, but it becomes the child's money. It's not the parents' money. The parents are just the custodian until the kids, kind of like UTMA and UGMA accounts. Those they're, once the kid turns age of majority, it's their money. So if you're just know that with those kind of accounts, that I'm not a big fan personally of UTMA or whatever. How many 18-year-olds are smart with a whole lump sum of money that just came in? Not many that I know of. Yeah, they're an adult, but they're not very good at adulting at that point, especially with a significant amount of money. So I'd rather control that, how much children get at what age. You know what I mean? People at 25 tend to be much more mature with money than they are even at 18. So some of the rules on these Trump accounts. Most standard IRA rules apply. And say that we'll see about that. We'll see what really happens with these Trump accounts as they get. But it's kind of cool that everybody gets $1,000. Children that are born, and then parents can contribute up to $5,000. They also don't need earned income. See anything else? I think this is it. But now we're going to alternatives. There is still just standard or traditional IRA, but your kids have to be working in order to contribute to an IRA. But if they are, and I know people that have used their kids as models on their website or what have you, different means of giving them earned income. It's a way to get them on these tax-free growth things. Imagine if you're investing in the market when you're born, one very young. That's that many more, doublings that you get as you get older. But the contribution limits are higher obviously for IRAs. And then for those taxable, I was talking about the UTMA and UGMA accounts. Those those are taxable. You're just a custodian as a parent, and then when the kid comes of age majority, it's their money to spend. But those are just basically brokerage accounts. There's not really a significant tax advantage, and the kiddie tax applies. I'm not going to go into that detail, but above a certain limit, that money gets taxed at the parents' tax rate, not the kids who making nothing. And then a 529 plan. There, you can contribute much more to a 529 than one of the Trump accounts, but it depends on what you use for. I know people as college has gotten so expensive, people wonder sometimes about the return on investment and how much to put into a 529. But there is, with those 529s, you can also it's got to be open for 15 years, all these specific rules, but you can, if the child doesn't use it or designate it to somebody else, you can convert some of that into a Roth IRA up to $35,000. But the number of restrictions there, and you can't go above what the annual contribution limit is to a Roth IRA. But if they haven't been contributing, you can do up to that limit each year, up to a maximum of $35,000. So, okay, I'm not going to go into this, but business owners, the QBI, the qualified business income, this is kind of beyond the scope for most people, was made permanent as well. So this gives small businesses that don't make too much money, it's a good tax deduction as well. And then here's some of the things just as far as things that were part of the Tax Cuts and Jobs Act in 2017 that have been extended. Exclusion of student loan debt due to death or disability. Fortunately, still the 5250 of employer paid student loan payments is excluded. Bonus depreciation, that's if you buy some huge capital, that you can deduct a significant portion, amount in 1 year, but that doesn't impact most the average people. ABLE accounts are for special needs children. So they've got some additional benefits, for ABLE accounts, which is good to see. And then we'll see what happens with this gift tax, but that increased again to 50 million per person federal gift tax, gift and estate tax. And then we'll see what happens, because that went up significantly. It used to, but we'll see if that's going to come down in future administrations as well, back to like 5 million or something like that. Any questions here? Okay, and overall, here's kind of just a summary of winners and who doesn't have really much of an impact. But highest earners, they don't, by keeping the tax brackets the same, are the most significant. Service workers up to we're collecting tips and overtime. Those, they have a good tax deduction as well. That's below the line. Seniors kind of making up. Whoops, should be a $6,000 deduction. Sorry about that, per person over 65. And may error there. And the kids, that's the kiddie tax. The child tax credit is huge. That's a significant one for people. And that child tax goes into people that have young children. You really should look at doing more Roth. There's such great tax benefits that your tax rate is so essentially low. If you're not building up your Roth dollars instead of using pre-tax money, you probably want to reevaluate that. So just something to think about. Moderate winners, everybody to standard deduction, which is 90% of people. Since that keeps going up higher, that's less taxes we pay. And then we've got that, just it's a small amount, but $1,000 per individual, $2,000 for married couples can donate to charity. That's not subject to that 0.5% AGI, and you don't have to itemize. It's just an additional $1,000 to $2,000 off. Let's see, minimal impact, high income, no state taxes. Yep, they're not. It's with that SALT taxes coming back up to 40K deduction. It's the high tax states like California, Texas, California, New York, etc., that are really impacted. That's about it. Okay, I think that's it. Questions here? Okay, I'm coming on. Okay, we still got a little bit of time. There's nothing, I just bring up, there's really not much for veterans and military, but I figured to just touch on it. There's, the beauty when people are active duty, so much of this stuff is tax-free already. It's really when you leave the uniform, that's when you're suddenly like, holy crap, taxes are so high. And do I get to keep any of my paycheck? I mean, I couldn't believe how small my paycheck was my first time outside of the uniform. I was like, God. So most of these don't, apply, but a lot of military, the tax tip in overtime for the spouse, that's a likely, potential win. And like I said, the standard deduction, that helps everybody that doesn't itemize. And then military retirees, just as all 65 years and older, getting $6,000 additional tax-free tax deduction. Okay. Here's just some thoughts of things to look at. Review your withholding, especially if you have number of kids, or you're 60, 65 and old, still working, because you're getting good tax credits back. SALT taxes, that's going to be interesting to see how, this coming year, how much that's going to impact. Could impact how much you do withholding. Document charitable giving, even if it's not that much, because you don't have to itemize to get at least $1,000, $2,000. And then if if you're under the cap, that new car loan, you can get those interest payments if final assembly is in the U.S. BINs 145, starting with BINs starting number 145. So tax planning wise, since these SALT taxes are only good, it's up to 40%, and then it might go back to 2029. This is time to consider paying, like, especially when you get in 2029. We pay property taxes like in November and April. They're due. It's actually, I think December 10th is the final limit in California, and then April 10th, or you pay a penalty. But you could take that payment in April of the 2030, pay that in 2029. Now you've got that whole property tax in 2029, when SALT taxes are, the deduction is still much higher. So it's something to consider. And let's see, anything else? Like I said, all this stuff's in pencil. What's permanent is permanent until the next administration comes in, or it doesn't even need the next administration. We'll see what happens. But that's I'm hoping the SALT doesn't drop back to 10K, but we'll see. Okay. And just some additional, I kind of talked about that. One more. Questions? Okay, here's some upcoming. Like I said, I'm trying to get back on it more like a monthly, just a regular monthly routine. I've still got a few more that it just takes a while to build out all these. But I've worked estate planning, long-term care, or house buying, things like that. So we'll be adding some additional topics. And if you have topics, let me know that things that you want to cover. But a number of these we've already done, but things change each year. So we'll be redoing, some of those, and I'll try to do it based on the timing of the year when those matter most.
Hey,
Question?
Alan.
Yeah.
I didn't get to read the article. I saw something earlier today about a $20,000 in California, $20,000. I think it was a property tax.
I'm not sure. You have to. I'm not sure what about $20,000 in property taxes? I'm not sure what you're.
It was an article
saying.
with Governor Newsom signing something that it was giving back $20,000 in property taxes to California residents.
we'll see. I'll take a look. I haven't seen that, so that's separate from the OBBBA. Obviously, it's a California thing. We'll see. I'd be surprised Newsom's giving us money back, but but there might, there might be some credits depending.
Okay.
Is what I bet, and that is. You know what I mean? It's all gonna be probably income related. As you know, like in California and most, like a lot of states, you don't pay property taxes as a disabled veteran. But there's a deduction in California if for any kind of disability rating you get. It's about a little over $1,000 a year savings. It's like up to, I think, 180K. They subtract off the value of your what they say the value of your home is that they tax it on. So that's one thing, but that's not 20K. So I'll take a look at May and let's see what this is about the property taxes.
Awesome, thank you. Yeah, because I was like, can we actually purchase a house in San Diego now, or that's still off the books? Yeah.
Well, it's still freaking ridiculously expensive. I guess the only good thing that I've seen with the interest rates being higher, when I've looked at mortgage, the selling prices, they've come down at least a couple $100K from asking consistently that I've seen on all the ones that have sold, roughly about 200K. So that's kind of good, because all those ridiculous gains from COVID, I mean, houses just can't go up. It's just, they just can't keep going up that rate. So I mean, I think we took care of more than what house prices can appreciate in a decade. They consistently, typically appreciate a certain value. We knocked that out by 2023 or so, and so now we're seeing, that them actually coming down to it's not realistic. It's still insane, but at least it's getting better. So, but it's hard. I mean, it's crazy. I think that the median home price is 960K in
San Diego,
greater San Diego. So yeah, not, you're talking even that's not the coast, that includes, even much more inland where prices tend to be a little bit better. So, okay. Any other questions? Okay. Well, like I said, I'll try to get these on just a regular recurring, like every third Friday or something like that. If you have recommendations for topics you want to discuss that I don't already have, let me know. And then if you don't mind, do you mind taking a quick survey? It's like a couple of questions, just lets me know what, if you guys found this useful, and if there's specific ways to improve, let me know. And I finished ahead of schedule. That's unusual for most of you to know. Any questions? And this doesn't have to be just about OBBBA, whatever.
Thanks, Alan. Real quick, again, for the new Trump accounts. So if your kid is still under 18, but not born in the $1,000 extra, you can still contribute to that. It's just not. It's not a tax advantaged account, or is it?
It's still a tax advantage account. You can contribute up to $5,000. You don't get the free $1,000 that the government's giving to all babies born January 1st, 2025 through December 31st, 2028.
Gotcha.
Makes sense.
Thank you.
So yeah, cool. Good to see you, man. It's been a long time.
Yeah, it has.
We're actually going up to your parts. I'm taking the nieces skiing next week for their ski week.
Oh yeah, you're heading to Tahoe?
Ski week, yeah. So
cool. I'll reach out on Slack. We'll chat.
Yeah, perfect. Sounds good. Yeah, we're going to Heavenly.
Nice.
Okay. Any other questions? Okay. Well, if that's it, I'll stop sharing, and I'm happy to stay on for a couple minutes if anybody has anything else you want to discuss. But otherwise, have a great weekend and week ahead. And I'll, like I said, I'll get these, I'll probably do one of the retirement investing vehicles, since all the the values have changed, you know, how much you can contribute for the year. Do that one coming up here soon with all the 2026 numbers. And remember, if you haven't finished your IRA contributions for 2025, you've got until tax day to max out your individual retirement account contributions.
Good to know. Thank you, Alan.
Yep, you're welcome.
Thanks, Alan.
Excellent. Thanks. Good to see you, George. See you at the gym.
Thanks a lot, Alan.
Yep.
Thank you.
Cool. See you.
Thanks,
Thank you.
Alan. Bye.
Thank you. Bye-bye. Nate, are you happy now? You're giving me a hard time for not having these,
Just flush.
For what?
for not having these for a while.
Oh, I don't know. You're fine.
How you doing?
I'm doing good. You?
Doing well. Just
Pretty
crazy
busy,
though.
right?
Oh my gosh, yeah.
Oh, you know what I was gonna ask?
What's that?
Did you need to tell me you did some hardware sips for AL1 and it was you know,
I got
hard?
23.
it was
No, okay, yeah. No, actually though,
oh, you're still recording if that matters.
yeah, I know. I was just thinking, so I turn this off. And okay, that's
Yeah,
it.
I think you
And
said something about it was a
I'm gonna
pain. I was
go-
gonna send a
Hold
message.
on a second.
You know.
These people, it's no takers since there's nothing.